Are you struggling to understand why the market goes up, down, or just moves sideways? You're not alone. One of the most powerful things you can learn as a beginner trader is how to read market structure. And that's exactly what I'm breaking down for you today in a simple and beginner-friendly way. No indicators, no complicated setups, just price and how it tells a story. Let's get into it. So firstly, what is market structure? Right. Market structure is just the way price moves, the sequence of highs and lows that form trends. Think of it as a skeleton of the market. When price is going up, it forms what we called higher highs, higher lows. And when it's going down, you would see lower highs, lower lows. This simple pattern is what professional traders use to understand market direction before adding anything else. Market structure has only three phases. And we have the uptrend, right, the downtrend, and the range or consolidation. Let me give you a pictorial view, right? So this is a series where market is making higher highs, as you can see here, higher highs, higher lows, right? And this is an uptrend, right? And we have also where market makes lower lows and lower highs, right? And this is called a downtrend, right? And then we have, of course, the range or consolidation, and this is when the market makes equal highs and equal lows, just moving sideways, right? So these are the main or the only three ways or phases of the market. Nothing else outside this. This is an uptrend, as I said earlier, right? This is a downtrend, and this is a range. All right. And how you depict the uptrends from the downtrends is when you see market making this is a low, higher low, right? Or when it then goes sorry, I'm trying to copy this. Okay, just leave it like this. Yeah, that's an higher low. Making this formation. Alright. There's another higher low. And then when it is making highs, it's making higher highs. As you can see here. Making higher highs. Higher highs. While for the downtrend, you see it makes lower lows and lower highs. Yep. Yeah. And for the range, it makes equal highs, equal lows. So it's equal lows, and for the top here, equal highs. So, and why this is important is for you to be able to immediately know or have an insight to what the market is doing, which will then allow you make decisions on what you are going to do next. The three main phases of the market, and of course I'll show you chart examples of this as we go along and as we go further. So now for the most important question, how exactly do we use these structures when making trade decisions, right? So the first thing is for trend continuation, right? If you see the market printing structures of higher highs and higher lows, right, don't trade against that trend. The best thing you can do is always follow the trend, never go against the trend. So that means once you see higher highs, higher lows formation, you just have to put yourself in an opportunity where you can get in on the buy, right? And two of the best trend following strategies that I preach about, and I have them in my previous videos, right, is either the break and retest, right, or the the Fibonacci. The break and retest just means when price comes back to retest a previously broken high or a previously broken low, something like this, right? So, well, of course, I'll use chart examples to explain that, right? And those levels also serve as entry points, right? Waiting for price to pull back to your levels, because when you're on an uptrend, your next or your best level to enter is always at the next low, right? And when you also want to put your stop loss, you have to put your stop loss at an invalidation level, simply meaning a level where you know that based on that structure, price shouldn't get to. So if we're taking a trade on an uptrend, we're taking our trade from the previous lows, right? And then we'll be anticipating to put our stop loss just below the range, and we'll be targeting the previous highs or new highs as our take profit, right? But of course, I'll still go into the chart to explain this properly for you guys, right? So that's that. Now let's go into the chart and show a real example. And on our next example, we see a market making new highs, higher lows formation. It's just going all the way, right? And then we're able to spot that this ranged for a bit, and then it broke this high. So because it's on a LD uptrend, we can just draw our fib from the beginning of that swing point. And if you don't really know how to draw your fib, I have a Fibonacci video. You can just go through. I'll link the video in this description, right? So where you can check out and know how well to use fib. So what happens next? We see price comes and bounces off this 50% level, right? You could have gotten in from there or decided to wait, and then they also give another rejection here, and you just take the trade, putting your entry around somewhere here, putting your stop loss just below that range, right? So you could have gotten in from this first entry or from this second one, targeting the previous highs. And what happens? Market goes boom all the way into profit. So there are a lot of, once you understand the market structure very well, it makes it easier to make trading decisions just based off the structure, right? And then another thing to also note, you can also spot when a break of structure is happening, right? Understanding market structure doesn't just cover these three phases, but these are the main three phases in the market. But a break of structure happens when you see something like this. So you see, let me delete this first, right? Let me delete this range, right? Delete it. Right, a break of structure happens when, hold on, yeah, a break of structure happens when maybe price was on an uptrend, right? It keeps going higher highs, higher lows, higher highs, higher lows. Then you see it makes maybe an equal high, right, failing to go any higher. Then on its way back down, it comes down and breaks below this previous, low, right? Now, according to us, this is a break of structure, right? Because it has broken below this previous low. So the next best thing that would mostly happen now, from looking at bullish opportunities, it makes our bias change. So what we'll be anticipating is a potential reversal from this point to this place. We'll see how candlesticks will react, and most likely price will keep going down, right? So basically, a break of structure is just when the normal sequence of the higher highs, higher low formation changes. So maybe from an higher high to an higher low, where price was meant to make a new high, is now making an equal high, or it doesn't get as high as the previous high, then it breaks the previous low, right? So this is an example from a bullish point of view. If it were to be a bearish point of view, to be something like this, it goes up, it goes all the way down, right? Then all of a sudden you see price breaking this previous high, right? Because it's meant to be making lower highs, but all of a sudden it made a new higher high, right? So that gives an idea that, okay, you know what, I think the structure is changing, and that's why patience has to be one of the things you also apply in trading, and especially combined with market structure. So you see, anticipation now becomes something like this to either go up, right, or whatever, depending on the market. And that's why we say is the skeleton of the market, because it shows what the market is actually saying, and we use that to then make decisions. Because one of the most important things to do in trading, before you make any trade or have any trade decision or any bias, you need to understand the direction of the market, what the market is actually saying. And you need to only buy in a buying market, sell in a selling market. If the direction is not clear, it's best to sit on your hands, right? So yeah, we can see in this gold chart, if you look at the chart very well, what we're going to notice, we notice that look at the chart very well, we'll notice that price came, it has been doing this series of making lower lows, lower highs, lower lows, lower high, then it made an equal high, then it came all the way down and broke the previous high. Now this is a break of structure, because the downtrend has broken here, because we were expecting or anticipating price to keep making lower lows, lower highs, lower lows, lower highs. Well, on getting to the previous high, he retested it, came down a bit and broke it. Now based off that, the previous broken high was our resistance. Then when price broke it, immediately became our support, right? And what would we be doing in that case? We would then have to start waiting for an opportunity to see what's going to happen when market revisits that level. And that's what we do. We wait to see, and upon revisiting the level, we got very good candlestick rejection here. My replay tool was too fast, so we would have taken our trade just after that rejection and that bullish candle and targeting this previous highs. And you can even see the market moved all the way immediately to a 1:2 trade, but we were targeting the previous highs, right? So that would be like a 1:3 trade. And if you fast forward and zoom, you see how price really moved, right? Depending on your trade management and how your system works, depends on how you would have managed your trades here. But this was a good risk to reward trade. For anywhere from a 1:2 to about a 1:4 trade, you would have made good profits on. But the common mistakes that most traders or beginner traders make, right? So like I said earlier, in trading, you need to be really patient, right? One of the mistakes made by beginners are trading inside a range with no clear direction. You know, when market is in a range and you see the market moving like this, right? Yeah, some people trade in the range, but I personally don't like trading in a range because it can always break out at any point. But if at all you want to trade in a range, it's always better to trade from the extremes, right? Maybe targeting the extremes, so selling from the resistance and buying from the supports. It's always best, but I don't really advise trading in the range because it can break out at any point, right? And confusing a pullback for a full reversal. Now in the case where this is selling, right, and this candle starts coming up, because they are anticipating that okay, we're in a bearish structure, so without any confirmation whatsoever, they start taking sales, expecting the market not to make an equal high. And this was looking like a pullback until it didn't look like a pullback until it became a reversal. So you have to be patient, and you have to also have certain indicators that with clear entry models and clear exit models. Except your system is telling you to buy, don't buy. Don't think for the market. Let your system tell you what to do, right? And also ignoring market structure or the higher time frame. I personally use, even the examples I gave, I use 4 hours, right? It just makes it clearer. Yes, I still have losses, but I just have a fairly higher accuracy using on the higher time frame. But whatever time frame you pick, make sure it's something you back test with and you've gotten your data to make better trading decisions, right? And also another one, like I said, always wait for confirmations. Don't just trade blindly. If you're going to buy, have your entry criteria, your reasons why you're going to buy. The main key here is patience. Let the structure guide your decisions, not just your emotions, right? And of course, to end it up, if you've made it this far, congrats to you. You now understand what market structure is and how to use it in your trading. This is the foundation for every successful strategy. So study it, watch price, and practice reading the story of the market, right? Understand what the market is telling you before you make decisions. Now, this is like a crash course, right? But the power is in the practice. You have to do a lot of practice so that you can, at first glance, you can always tell what the market is saying and you can make better trading decisions. All right. And if you learned something new today, please leave a comment, share, like, and subscribe, right? And follow for more trading education like this, right? I'll see you guys in the next video. Bye.